guys, it's Sasha. Today I want to tell you about some really interesting things about stocks and shares ISAs. I won't talk to you about the very basic things that most people know. If you want to understand better what ISAs are, how they work, all things like that, I will link my complete guide in the description, so go and check it out. But in this video, I thought I'd talk about some of the points that many people don't know about stocks and shares ISAs. A few really crucial things that people sometimes get wrong with stocks and shares ISAs that can be very painful and frustrating and can lose a lot of money if you get them wrong. Now, if you're just getting a stocks and shares ISA for the very first time, maybe because it's a new financial year or you've been saving into one for a few years already, you might find some of the tips in this video helpful and maybe some things that you didn't even know. Now, very quickly, what is a stocks and shares ISA? It is an account available in the UK to investors where you can invest in the stock market without having to pay any taxes. I'm going to come back to this bit in a minute. You can see I put an asterisk next to the no taxes bit. As with all ISAs, you don't have to pay any capital gains tax and you don't have to pay any dividend tax or any other major kind of tax when investing in a stocks and shares ISA. This means you can invest your money in the stock market, and however much it grows, it doesn't matter in the future, you won't have to pay taxes to the UK government at all when you decide to cash out. This is a huge advantage when investing in stocks. The UK capital gains allowance has just been reduced from £12,300 a year to £6,000 as of this financial year. And in the autumn budget, the Chancellor announced that it will halve again to £3,000 from April 2024. Who knows, it could go lower from there afterwards. The dividend allowance has already dropped from £5,000 to £2,000 a few years ago, and it's just been reduced to £1,000, and next year it's going down to £500. So if you invest outside an ISA, you will have to pay these taxes, and although dividend tax and capital gains tax are lower than income tax, they are still very substantial, and an ISA lets you avoid paying them altogether. You're allowed to put in up to £20,000 a year into your ISA, which is more than enough for most people, and there is a risk that this annual amount will reduce in the future because, if the government needs more money, this is an obvious place to try to get it, so you might want to go and use your allowance while it's there. Now, the first quirk I wanted to highlight is about those taxes. Unfortunately, although a stocks and shares ISA is tax-free, you still have to pay some taxes. So although you don't pay capital gains and dividend tax, you still have to pay two other types of tax. The first one that you have to pay is stamp duty. If you buy UK stocks, you will have to pay a 0.5% stamp duty every single time you buy a stock, including inside an ISA. So if you go and buy £100 worth of shares in a company trading on the London Stock Exchange, Royal Mail, Barclays, whatever you like, you will have to pay 50p in stamp duty and only receive £99.50 worth of stock. This tax only applies on buying but not on selling shares, so you only pay it once. There is a similar tax in some other European countries as well, so if you're buying stocks that trade in France or Switzerland, for example, you'll have to pay that stamp duty there as well. And the second tax that you have to pay is dividend withholding tax. This one's quite important, but many people don't know it exists. So you don't have to pay UK dividend tax inside your stocks and shares ISA, but other countries will often take a cut of the dividends that you are owed before you receive them, and this is called the dividend withholding tax. US is the most popular stock market in the world. Many people watching this video, you probably will be investing in US stocks, and if you invest in US companies, you will lose 15% of the dividends that those companies pay you because of this dividend withholding tax. You won't have to do anything. You don't have to pay it. You don't have to go and find the IRS or fill in forms online. The US tax man will take it out of the dividends before you even see them appear in your account. Now, this is not a big issue for most investors. The most popular companies in the US either pay no dividends, the big tech giants like Tesla, or pay very low dividends. The S&P 500 overall, the entire 500 biggest companies in the US, only have a dividend of 1.63% a year at the moment. It's been falling continuously for the last few decades. If you invest in the S&P 500, the majority of your returns will be from stocks increasing in value, not from receiving dividends. And on average, over the long term, the S&P 500 returns about 9 to 10% a year. So at the moment, 1.63% of that 9 to 10% comes in dividends, and you have to pay 15% of that in dividend withholding tax, so you'll lose about 0.24% a year as a result. Now, 0.24% out of 9 to 10% total return is not huge, but it's useful to know about. And I also know that a lot of people on YouTube recommend that people go and invest in dividend stocks for whatever reason. Well, if you invest in dividend stocks based in the US, for example, inside your ISA, you will lose 15% of those dividends, and that is a lot. But you don't lose anything on the growth in value of your shares because there's no capital gains tax, so that's just something to think about. Also, the same dividend withholding tax applies in some European countries as well. Now, very few people will be investing in European stocks, so this is probably not going to affect most of you watching just from experience, but just something to be aware of. The next point is a quick one, but it's super important, and many people don't understand this bit properly. You can only pay into one stocks and shares ISA in every financial year. So from the 6th of April in any one year to the 5th of April the next year, you can only pay into one stocks and shares ISA. And that means that every financial year you have a choice. You can go and open a new stocks and shares ISA if you want and start paying into that one, or you can keep paying into your old one, any one of your old ones, and continue paying into the same one for the rest of that financial year. If you open a new stocks and shares ISA, you can keep your old one. Nobody forces you to close it. So if you open a new one every year, you can have as many as you want. And you can keep buying and selling stocks and all of your old ones as much as you want. There's no restriction on that. And you don't have to move your old ISAs if you open a new one. There's absolutely no one telling you to do that. You can move if you want to, because maybe you want to save on fees, but you don't have to. Now, I have links to the best value stocks and shares ISAs in the description, and there is a link to a video where I break down the best stocks and shares ISAs out there if you want to go and check it out later. Remember that a stocks and shares ISA is only one type of ISA. You can also have a cash ISA, a lifetime ISA, or an innovative finance ISA. That last one is just lending money to people. You can pay into one of each type of ISA within the same financial year. So you could go ahead and, for example, open a lifetime ISA and a stocks and shares ISA, two separate ones, and pay into both, for example, in the same year. And this brings me nicely to the third useful hack. You can invest more than £20,000 into ISAs if you wanted to. Now, it's not rocket science, but people often see the £20,000 allowance and they don't think outside the box. £20,000 is a lot. So for most people, you will never need a bigger allowance. But life has a funny way of throwing things at you. Maybe you'll sell your house and decide to rent or downsize. Maybe you'll get an unexpected bit of inheritance. Maybe you'll get a big bonus at work. Maybe your salary increases and you can afford to save more into your ISA. Whatever the reason. Remember, the £20,000 allowance is per person. So if you're a couple, for example, then each of you gets that £20,000 allowance, and you can open an ISA each. And each of you can put that amount into your own ISAs. And if £40,000 is not enough for the two of you, there is a junior ISA allowance of £9,000 per child. There aren't as many good junior ISA options out there, but junior ISAs eventually convert to become normal ISAs when the child turns 18, and at that point you can do whatever you want with it. So as a family, you can save a heck of a lot of money into ISAs every year if you want to do it, if each member of the family has their own account. And remember, the £20,000 per year limit is only on deposits. There is no limit at all on how much your ISA can grow. If your ISA grows to £1 million or £10 million over time or whatever, because you are the next Warren Buffett and you made such good investments, you can go and withdraw the full £10 million and pay no tax whatsoever. And while we're in the topic, the next really important point is not to pick your ISA just based on the fees alone. Often people comparing ISAs just look at the fees and say, well, this one's the cheapest and I'm going to go and get that one and open that account. And recently, a lot of new brokers have turned up in the last few years offering free ISAs or almost free ISAs. The problem is that when the ISA is free, it means that the company that is offering it to you is losing a lot of money because they have to operate it and have staff staff and offices. There is an old Russian saying that says that the only free cheese you get is in a mousetrap, and sure enough, in recent years, Trading212 offered a free ISA and then introduced a 0.15% foreign exchange fee. Now, their ISA is still one of the best value out there, and it's the cheapest on the market for those investing smaller amounts. That's one of the links that I have in my description, but it's now not free. Freetrade also increased their fees substantially multiple times since they arrived, so you can get a great deal from these new brokers, but just be careful of that bait and switch, because if your broker suddenly decides to stop being free and magically increase their fees, you might have to move to a different provider if you don't want to continue paying those fees. And surprise, surprise, most of these new brokers don't let you do in-specie transfers out. Sometimes you can transfer in, but not out. And in-specie transfers out just means that you can't move your shares to a different broker if suddenly they just tell you that their fees are increasing. So if that happens and you want to move, you'll have to sell all of your shares, pay all of the fees for selling the shares, then move the money, and then buy those shares again with a new broker paying even more fees. And if you do that, you might lose a heck of a lot more in fees by doing it than you would have saved by opting for the very cheapest broker in the first place. Now, having said that, the best known old school brokers that everyone knows about, like Hargreaves Lansdown, have astronomical fees. You have to pay 0.45% a year on annual management fees, and a separate 0.45% on any funds you invest in, and you have to pay £12 every single time you buy or sell shares. So if you put in £100 a month and you buy one stock, not multiple, you still have to pay £12, 12% of the money that you're putting in for just the ability to invest is mind-boggling. And you have to pay 1% in foreign exchange fees on top of that fee when you buy foreign stocks, for example, if you invest in US companies. So yeah, beware of brokers that are free, but that does not mean that you should go and pay absolutely insane, ludicrous amounts in fees to Hargreaves Lansdown either, or any of the other old school providers charging similar amounts. If you want my take on the best value stocks and shares ISAs, I have links in the description, and there's a video there that explains all the main options and explains how expensive they are. The next really important point is that not all stocks and shares ISAs let you invest in stocks and shares. Now, there are a lot of ISAs that brand themselves as stocks and shares, but the only thing that you can buy inside them is one of a very small number of proprietary funds. They're very mysterious, and these funds carry very expensive fees, and even the highest risk option that they offer severely underperforms the average of the stock market return in the long term, which makes absolutely no good sense. These providers bank on people wanting to minimize their risk. They want someone to hold their hand. They play the investing is very hard, be careful out there, it's very dangerous. They play that marketing game so that a lot of the less savvy investors go and opt to have their ISAs with them so that they can then sell you those funds. And hey, this is a personal opinion. Maybe I'm wrong because, some people might prefer a bit of hand-holding. People are scared of risk. And these funds don't oscillate as much as the stock market. So for example, if the stock market has a bad year and loses money, these funds might not lose as much money. So in a way, I guess there are some upsides, but they also make far less money in the good years than the average of the stock market. But for me, the stocks and shares ISAs from the likes of Money Farm, Wealthify, Nutmeg, etc., are not real stocks and shares ISAs. You can't invest in actual stocks. You can't invest in ETFs. You can't invest in stock market index. You can't expect to even match the average stock market return based on the numbers they provide, let alone have any chance of beating it. So I personally would never recommend to my friends any of these options, and I would never promote them. For anyone who doesn't want the risk of investing in stocks and shares because you don't like the oscillations up and down, and maybe you can't sleep at night because you're worried about your money, well, there are other types of ISA that on average have lower returns but have none of the risks associated, so they might be the better option for you. And this brings me nicely to point number 6. Stocks and shares ISAs are actually great because they only let you invest in good things like company shares or ETFs. Now, not every company is a good investment, and some will be really bad investments. But ISAs in the UK are restricted compared to regular investing accounts. So inside an ISA, you can't gamble. This is a really good thing. In an ISA, you can't go and buy options or buy futures. You can't trade Forex because money in your account has to be kept in pounds at all times. You can't buy CFDs or any other kind of instruments. And this is really good because the vast majority of these things are really not appropriate for retail investors. Many of these are extremely volatile, very difficult to actually understand, which means a lot of new investors will often go and start gambling with leverage or short-term options or whatever, and then lose all of their money. This happens all the time. In an ISA, you are not allowed to buy any of those dumb things, so the temptation just isn't there, and you can't accidentally go and do something really stupid by buying a 10x leverage CFD without maybe quite understanding what that means in terms of risks. So an ISA is great for buying stocks and shares, and also great for not letting you invest in all of the junk. And point number 7 is that most stocks and shares ISAs are not flexible. All 3 of the good value options are listed in the description below are not flexible. And it's really important to know this. It means that if you take your money out of your ISA during a financial year, you can't go and put it back in. So for example, let's say you have an ISA. You have a £20,000 annual allowance, you put in £10,000, and then you urgently need to take £2,000 out to, say, fix your car. If you withdraw that £2,000, because you already put in $10,000, you can still only put in another $10,000 back into the account. So in total, after you take out the $2,000, you will have only kind of contributed £18,000 that year. Again, this is probably not a big issue for most people, but just something to be aware of. If you take money out of your ISA, you are kind of losing a part of your allowance for that year if it's not flexible. So you can't just temporarily borrow money out of your stocks and shares ISA if it's not flexible. I hope you found this video useful. Remember to check the links for the best stocks and shares ISA in the description, and watch this video to see a complete breakdown of all the best options available and me explaining all of the fees. Thank you so much for watching, and I'll see you guys later.